The nation's unemployment rate dropped to 4.6% in November, the lowest level since the recession, and 178,000 jobs were added to the economy. Now all eyes turn to the Federal Reserve and whether it will raise interest rates in December. Joining us to discuss is WSJ Chief Economics Commentator Greg Ip. Hi, Greg. Thanks for being with us.
Hey, Tanya.
So this jobs report came on the heels of an upbeat housing report this week as well. Is all of this enough for the Fed to make a move on rates?
Oh, I would think so. I mean, as long ago as a month ago, they basically were in default mode that they were going to go in December unless the data turned out to be bad. The data hasn't only been good, it's actually been a little bit better than expected. So I see very little to stand in the way of them moving at their next meeting. All
right. Now, while the jobless rate did dip to its lowest level in 9 years, wages have yet to return to their pre-recession levels. Will that be a concern for the Fed?
It will be, but I don't think it's enough of a concern to stay their hand. The wage numbers were a little bit troubling in this report. We saw a 0.1% monthly decline. The annual rate dropped to 2.5 from 2.8% in October. But I would have a cautionary note before I would worry too much. There were quirks to the calendar that caused the number to be overstated in October and understated in November. So the real trend on wages is still probably around 2.5%, which is a very modest acceleration from a few years ago. When you consider the fact that productivity growth is also extremely weak, 2.5 to 3% is probably a good approximation of the trend. So I don't think there's anything here for the Fed to worry about too much.
And Greg, in terms of who was hiring most in December, which industries stood out to you?
Well, I think one of the notable gains was in construction. That's a positive sign. It shows, as you were talking about the housing numbers the other day, that the residential construction sector continues to be a very good contributor to overall economic growth. We also saw gains in government, and we saw gains in business services. On the troubling side, we saw retail employment drop. Now, these numbers are seasonally adjusted, so what that's telling you is that while retailers are adding workers for the holiday season, they're not adding them at the same pace as they have in previous years, so that's a little bit worrisome.
Absolutely. Are there any other economic headwinds that you see on the horizon that could potentially slow down the growth we've seen?
Well, we certainly have a lot of uncertainty related to the political situation, but so far the markets have liked what they've seen from the Trump administration, so that doesn't seem to be a big worry. The dollar has gained a lot of strength since Trump was elected, partly because people are expecting fiscal stimulus, higher interest rates. That stronger dollar could be a negative for export industries and for manufacturing, which is kind of ironic considering the emphasis that Trump has placed on both manufacturing and exports. I would say the final point to keep in mind here is that the overall pace of job growth continues to be very strong, much stronger than what the economy can sustain in the long run, given the fact that this is an aging country. And the Federal Reserve is basically going to say, we need to start moving interest rates back to a normal level because we still have a labor market that is hotter than it can stand to be over the long term.
All right, Greg Ip, thank you so much for that analysis.
All right, Tanya, thank you.